You know, something I've noticed over the years is that people love to overuse the term recession. Even when we're not actually in a recession, people will complain about things and refer to the recession. Like after the Great Recession, which was due to the financial crisis, the UK was one of the last countries to officially be out of it in the last quarter of 2009. Yet for many years after that, you'd still hear people complain about it and state things like, well, after all, we are in a recession. But we weren't. Many areas of the economy might not have fully recovered from the recession, but the economy was not in a recession anymore. And so with talk of a recession being a big topic again at the moment, and over the past couple of years, you're going to be hearing the term being used incorrectly a lot more once again. And you know, that's fine in most cases. You kind of get what someone means when they're using the term. But when we're talking about the financial markets or economics, it's better that we're precise about things. So with that in mind, what is a recession? So in basic terms, a recession is a prolonged period of time where the economy is in decline. Now in the UK, this is defined as being negative economic growth for 2 consecutive quarters, whereas the US National Bureau of Economic Research, the NBER, defines it as a significant decline in economic activity that is spread across the economy and that lasts more than a few months. So how a recession is actually measured can be up for debate depending on the country you're in and the person doing the analysis. However, a general rule of thumb is that a recession is when the economy is in decline for 2 quarters in a row as measured by a decline in GDP, gross domestic product. Click up here if you're not sure what that is. So during a recession, consumer spending and investment tends to decrease. Businesses slow down production, they lay off workers, and that leads to higher unemployment. So a recession is typically a bad thing for the economy. However, that can depend on the context. Although nobody wants a recession, it can sometimes be better than the alternative, such as high inflation. So that brings us on to how recessions start. There are many factors that could influence or push an economy into a recession. These might be major events that ripple across the whole globe, like a financial crisis, a pandemic, or a war. But in other cases, it may be that a recession is caused somewhat on purpose, like when a central bank raises rates to deal with high inflation, which is what we saw happening in the early 1980s and following on from the recent pandemic. You may remember we spoke about the Volcker shock in one of our last videos, so check that out if you haven't seen it yet. But the problem is, since a recession is defined as a sustained period of time, or 2 quarters of negative economic growth, we might not actually officially know that we're in a recession until half a year later. That's not exactly having your finger on the pulse now, is it? But in some cases it can be pretty obvious, by looking at things other than GDP. Like for example, we can look at unemployment data, or even the context of the situation. Like when governments introduced lockdown measures a couple of years ago, it was clear the economy was going to go into a recession without us needing to see GDP data. It was obvious. But in other cases, it might not be so easy. It might be that labour markets are more resilient, so we can't use unemployment data. Like when the Federal Reserve raised rates in 2022. Because of that, there was a lot of discussion about whether or not the economy was actually in a recession. So when does a recession become a recession? Although many economists and analysts will stick with the 2-quarter rule for defining a recession, it isn't actually as straightforward as that. This is where the NBER comes into the equation. In the US, they're officially responsible for defining recessions and putting a date on them. However, they say there are many factors for defining a recession rather than simply looking at economic growth. For example, if the economy is in decline, but unemployment remains low, is the economy really in a recession? Does that fit the definition of a significant decline in economic activity? If there was a significant decline and it doesn't impact the labour market, that's a conflicting signal. Therefore, in order to determine a recession, they take into account several factors. They give the most weight to non-farm payrolls data, NFP, and real personal incomes, but they also take into account other employment measures, retail sales, and industrial production. They do also use GDP, but at least in the US, the data isn't available monthly. So while the actual statement from the NBER may come out months after a recession has started, we can look at similar data points to what they'll be looking at and preempt when that statement may be coming. Although, having said that, It might be that that's the official statement, but that doesn't necessarily mean it's correct. There are lots of conflicting opinions about what measures do allow you or don't allow you to predict or confirm a recession. In fact, a study by the IMF found that only 2 of the 60 recessions that happened around the world in the 90s were predicted by a consensus of economists a year earlier. And there were no consensus predictions for the 49 recessions that happened worldwide in 2009. So with that in mind, I guess I can't complain too much about people using the word recession incorrectly because maybe they're correct after all. Anyway, check out these 2 videos if you want more recession indicators. Even if it is a bit of a grey area, the more you know, the better you'll be able to perform with your decisions in the markets. Thanks for watching.